Well, gotta make do with what I got since my Bluetooth went out. Say what's alright. Ready. Small things, and I say what's wrong, alright. It's not hard for me. I'm addicted to good life. Sad, but wait, to see where we are heading now, babe. Maybe I tried it all. Maybe I tried it all. So tell you, yeah. So all right. Yo, 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 yo. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall. And I'm here today to whap and tap on your head with another ADH wealth solution. So today, as you see, the topic is Tea and Muffin Tuesdays. And the reason why is because I'm going to bring you into a preview of my self-employed tax advantage plans with our special guest speaker, Roseline Gordon. It is a Zoom meeting, so what I'm going to do is I'm going to try and share my Zoom screen with you guys. I don't know if I can do Zoom and StreamYard simultaneously, but it's not my Zoom. If it was, I would just broadcast it to YouTube. So, ladies and gentlemen, if you're enjoying the content, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional, the links are in the description of this video. So, as we proceed to give you what you need, let me go ahead and launch this Zoom meeting. And I'm going to stop this screen, my cam, and continue to share the screen. Anubis, what's going on? Hopefully it doesn't stop my mic from up here with you guys. If so, I'll try and come on through my cell phone so you guys can at least get a little bit of the preview of what's going on. I'm also going to try and tune in through YouTube. Hold on.
We go way back. We went to Murray Bertram High School for business careers, and she's an accountant. She has her practice, the Gordon Financial Group, and we are actually blessed to have her as part of the CG Wealth. She has the emeritus contract, and she's actually a tax preparer, right? Mm-hmm. So we are blessed to have a professional that knows the ins and outs of the taxes. Like I said, I got this letter this morning, and I'm still wondering how I still owe more money to the state, right? And she's going to help us with that. So with that said, Rose, I'll pass it to you. I'll let you introduce yourself, and I'll record.
Okay. Hi, everyone. I'm Roseline
Recording
Gordon.
in progress.
As you guys may have seen me before, hopefully, can everyone see the screen?
Yes.
Okay. So for the sake of time, I'm just going to jump right in it, here with you. So I have a business management firm. I'm located in Islip, New Jersey. One of the things that we do is we offer client accounting services as well as tax advisory services.
Ladies and gentlemen, hit a 1 if you guys can hear what I'm saying, or if you can hear the
Zoom. End of the year, And there are a lot of 2023 last minute deductions that business owners can take to kind of help out their tax situation. And so today, I guess because of the nature of the business, he wanted to focus on retirement, which can bring a lot of benefits. And if we have some time, then I wouldn't mind sharing a couple of other tax strategies and loopholes. Just disregard the date. This was from a previous presentation. So I wouldn't mind sharing some other tax strategies and loopholes that you can definitely use as a sole proprietor or as a Schedule C preparer or even as a preparer in preparation if you are today. Okay. So just like I said, the agenda is we're gonna hit on some tax strategies around the retirement. Okay, so I just have to do a little disclaimer. And the reason why is that there's so many things associated with this that the information may change. So some of the information may include interpretations and opinions that may not align with how the IRS or court would provide these provisions. So we may receive updated guidance from the Treasury, Congress, or IRS that may change some of the following information. So it's important when you decide to implement that you make sure that you're getting the most current rules attached to what you're doing. So for the sake of time, I'm just going to kind of pass through some of these other ones, and we're going to hit on the retirement. If you just give me a minute here. So the first one I wanted to introduce was the Simplified Employee Pension IRA. Is affectionately known as a SEP plan, and the tax deductions that are contributed to a SEP IRA, they are tax deductible for the business or self-employed individuals making contributions. Okay, so what the contribution from a SEP IRA does is that it reduces your taxable income by the amount you contribute to the SEP IRA. So a couple of weeks ago, Charles and I had this discussion, and he was asking me a question, and I was kind of way ahead of him. I was giving him an answer to something else, but I believe, right, Charles, that this might have been what you were asking me, whether or not it lowers the taxable income. So whatever you contribute, just know that the simplified employee pension is not a dollar for dollar tax deduction. It simply reduces your taxable income that you contribute, okay? And then as a result, it lowers your overall tax liability because your taxable income is reduced by the contribution amount. And I'll go on to more of that later. So when you contribute to a SEP IRA, you can deduct the contribution from your business or your individual tax return, depending on how you're filing. And the exact reduction in taxes depends on your tax rate. So this is just an example so you can kind of understand. We move this a little bit out of the way. So suppose you are a self-employed individual and you had an annual income of $80,000 and you, for argument's sake, fell into the 24% federal income tax bracket, and you decided that you wanted to contribute $10,000 to your SEP IRA during the tax year. So here's how it would kind of look if you did that, okay? So your taxable income before the SEP IRA contribution was $80,000 before any deductions. And then you made a SEP IRA contribution of $10,000 to your SEP IRA, right? So this is how your taxable income would look after. It will be reduced by the amount of the contribution. So it'll be 80,000 minus 10,000 will give you 70,000. So now your new taxable income is $70,000. Okay. So again, the taxable income before is 80. Your taxable income after the deduction is 70,000. So the taxable income reduction equals 10,000. So the tax savings at the 24% tax bracket is $10,000 times 24% will give you a total of $2,400. Okay, so that would be your total tax savings if you were in this tax bracket and you contributed $10,000. So what you can do is think about what your taxable income is, think about the amount of the contribution that you're going to make, and reduce it, and then take the amount that you've made and times it by your tax bracket, and that will give you what your total tax savings would be. Now, the contribution limits for the SEP IRA, an employer usually makes these, and they cannot exceed the lesser of 25% of the employee's compensation or $66,000 for tax year 2023. The contribution deadlines are March 15th, 2024, or by the extension date for businesses other than C corporations. And if you are a C Corp or Schedule C 1040 filer, the contribution deadlines are April 15th of 2024, or by the extension due date, which in this regard is on or around October 15th. And for other businesses, for C Corps, that will be on or about September 15th. Okay. What I would like to say about the SEP IRA is the contribution rate. So one of the things that you have to keep in mind is with a SEP IRA, you can do this if you have employees or if you do not have employees. But if you do have employees, know that the same percentage that you contribute for yourself would be the same percentage that you have to contribute for everyone that's employed under you. You can't do a simplified employee pension plan just for yourself and not do it for your employees. So if we had to weigh pros and cons, that is something that you would consider if you wanted to do a simplified employee pension plan. And what I found out from Charles, which I didn't know this entire time, was that that's something that we can do. I am also affiliated with another insurance company, and as long as I've been with them, simplified employee pension IRAs can only be done by individuals who have their security licenses. So I'm trying to unpack that because, Charles showed me a different method. So I'm not going to dwell on it too much, but it's just interesting to know that I've been giving away all of this business for so many years, and I could have been doing it for myself. So this is something that I would like for you to consider for yourself. If you are interested in a SEP plan, or if you have a business and you also have employees, it's very good option to consider, especially with the $66,000 max if you're a high earner. Yeah, and then not only are you going to get the contributions for yourself, you'll also get the deductions that you take for your employees as well. So it can really pack a good punch on your taxable income, that eventually, if your S Corp gets transferred over to you personally, even if you're a C Corp, and especially for Schedule C. So the other self-employed retirement plan that I wanted to talk to you about today is a solo 401k. The contributions you make to a solo 401k are typically tax deductible. Contributions are deducted from your taxable income for the year in which you make the contribution. And we'll hit a little bit on some of those changes in a little bit. It lowers, again, just like the SEP, lowers your taxable income, potentially resulting in lower taxes. And with the solo 401k, unlike the SEP plan, it's mainly for self-employed individuals with no employees, with the exception of you have a spouse that is employed by the company. Well, just like the SEP IRA, the investments within the solo 401k grow tax deferred. And what's unique about the solo 401k is that some solo 401k plans now they offer a raw sub account where contributions are made with after tax dollars. One thing to consider if you do a solo 401k and you contribute to that Roth option, that the portion that's Roth is not going to provide you with a tax deduction, but it's a good combination in planning if you believe that you're going to have a high tax bracket at retirement time. So you'll only pay taxes when you pull out the money that's in the solo 401k portion and not the Roth IRA portion. What I like about the solo 401k is that it allows for higher contribution limits compared to the SEP IRA. And we'll see a little bit about that in a little bit. Like I said, it can be very advantageous for those who want to maximize their retirement savings and potentially reduce their taxable income. Intentionally. So the contribution limits for a solo 401k in 2023, the max you can contribute is similar to what you would in a regular 401k as the employee. Plus, as the employer, you will also be able to contribute an additional 25% of the earned income as the employer, right? So that's where when I mentioned earlier about, it gives you the opportunity to contribute much more into the plan than it would with the SEP plan. That's definitely a possibility because of that option. And then you have the option if you're 50 and older, as some of us have turned this year, or we are already, you can contribute an additional $7,500 as an employee for 2023, right? So your combined employee and employer contributions cannot exceed $66,000 or $73,500 for those who are age 50 and older.
Hey, Roseline, who's 50? I'm knocking on 40's door. What you talking about?
But this is very good for some of us who have already knocked down the door. Okay.
Okay.
Now, the SEP IRA unfortunately does not offer you a catch up, so you don't have this option of contributing an additional funds into the SEP IRA. Okay, let's see where we are. So, Secure 2.0, everybody's kind of familiar with that. There's so much moving inside of that whole act that is so hard to keep up with everything. But in the case of the solo 401k, the Secure 2.0 Act allows you to open the solo 401k by 4/15 of 2024. In the past, you had to have all of this in and stacked by December 31st of the current year that you're in. One of the things that I would say is what you can do is if you're going to make that decision to make this a 2023 last minute year deduction, is to consider, especially if you have a W-2 in your business, is to consider adjusting that last quarter by January 15th to reflect the contribution, okay? Otherwise, then you're going to have to pay your payroll company and the government a late fee or a penalty for making the adjustment after the January 15th tax date. Either here nor there, it still allows you, because of the Secure 2.0, to open it up by April 15th and get it all funded, okay? Now, if you do that by April 15th, it's very important to be adamant with your provider about the tax year that you're going to apply these funds. A lot of times, some people get caught up with the last minute contributions and not realize that the provider applied it for the current year. And now they're trying to take this deduction, and the IRS is like, nobody, it was applied to the previous year. And you just, you don't want the IRS in your business. So you just want to be adamant about when they apply the contributions, okay? So we had to look at the SEP versus the solo 401k. The accountant part of me would say this: consider all of your goals, consider your cash flow, of course, consider your income, consider your age. With the solo 401k, there are administrative fees, as well as with the SEP, but not as much. And with the solo 401k, there are some admin duties. Once your fund reaches at least $250,000, you're required to file Form 5500 with that. And it's a pain in the neck. It can be, because you have to make sure that you file it in on time. If you don't, you have to do some amending with the Labor Department. Then you have to make sure that the IRS gets it, because the IRS, for whatever reason, they're late with a lot of notice. But if you do not file that Form 5500, it seems like they know instantaneously. And they will send you out the form with a penalty. In the past, I've seen that when you eventually do file the Form 5500, they will reverse the penalty. But with everything going on, I just would not take the chance in 2023 to file late if you decided that you were going to move forward and move with the solo 401k. And what's really good with both of these options, whether you go SEP or solo 401k, is that because of the Secure 2.0 Act, there are additional tax incentives for just setting up a retirement period. Now, this is just something that came to my mind because I just find it very interesting that over the course of the years that we've heard all of this stuff about Social Security depleting. And, while it's always been on the back of my mind, it's more in the forefront now because of the Secure 2.0 Act. They are basically giving away the cow for free and encouraging people to do this. And not only encouraging you, they're starting to make it mandated in certain states and so forth to offer this. And, I can play around with the thought and I could say, well, why is it that they're encouraging us so much to the point where they're starting to mandate getting a retirement plan in place? And the only assumption I can come up with is the whole concept of the Social Security running out is true, and that they're doing everything in their power to cover their, what. So.
And not only that, Roz, my suspicion is they plan on increasing the tax rate sometime in the future. Because remember, these contributions are going in, it's being excluded from income, and the accumulation is growing tax deferred. So like in your example now, what was it, 24% tax bracket? That could be 52%.
Yeah.
20 years from now. So they know, hey, that's one of my suspicions in addition to what you're saying, that the tax rate will go up.
Yeah.
And that they can get more revenue down the road.
Yeah, so it's kind of like wanting to cover up, cover it all up, which was the next thing I was going to say. especially if you're a high earner. Like it starts to make, they're trying to do all of these things so that people aren't saying that they're duped. Now, this is, of course, speculation, but it makes sense, right? If we make it and create an opportunity for them, when have you heard that a set plan may have a Roth contribution? A Roth component. When have you seen 401ks have, you have the option before, but like these solo 401ks now having a Roth component, and even the simple IRA, which we didn't talk about today, and I'm not going to talk about it today, they're even making those with a Roth component. So there's something to be said about all of this tax incentives and the push to really get these retirement plans in place. And I just think that now is the time to just really take advantage of it, So let me see if I can pull up really quickly, if you don't mind. I wanted to kind of look at something to just give you, since I do have a little bit of time, to see some of the incentives. I'm sorry about this email going off so much. And what they're offering.
In the meantime, does anybody have any questions on anything? I'm just pulling that up.
Yeah. So some of the things that that you can claim up to $15,000 in tax credits by having your business create a retirement plan that covers you and your employees. Now that is in addition to the savings that you get for the contribution. That's just an additional tax credit for the business. When have they ever done anything like that, right? And then for you can claim, and for 2023, there's a new 2023 small employer pension contribution tax credit that will give you up to $3,500 per employee. Okay. And you can claim up to $1,500 in tax credit by enabling an automatic contribution. That means if you will set up the solo 401k or the set plan, and you have it where they automatically deduct the money, they'll give you a tax credit. Okay. So that was just something I wanted to add, just to give you an idea of how serious this is and how important it is to take advantage of the opportunities if you can. And even if it's not for yourself, this is definitely something I'm sure that you have clients who have businesses. This is really, and you can offer these plans. This is really good. And I'm sure that they will really appreciate it. Number one, because of all the tax savings that they can get. And number two, the states are starting to offer retirement plans to employees. So if employees can go to a marketplace now and they can just get a retirement plan, who knows what it's going to be, but you miss out as the employer on taking on that tax credit when you can put this in place, providing your cash flow can afford to. So I just wanted to give you an example of what it might look like, because there are different reasons, like I said, that you might want to pick a SEP versus a solo 401k. So in this example, we'll call him Brad. He earns $19,000 as an independent contractor. So under a solo 401k, he can contribute almost all of his net earnings, right? Because with the solo 401k, you can contribute as the employer. He's his own boss. And then he can contribute as the employee. So pretty much he can wipe out his entire revenue, taxable revenue, by contributing to a solo 401k. Now, if you wanted to compare and contrast that with a set plan, if he contributed, he can only contribute up to 20% because he doesn't have employees as a solopreneur. So you take 19,000 times 20%, and he'd only be able to contribute $3,800. So if I had to choose taking $19,000 to reduce my taxable income or taking $3,800 to reduce my taxable income, I'm definitely going to go with the 19,000. So that's one of the reasons why I gave this example, because it's important to look at the entire picture, not just look at, oh, you can contribute 78,000 here, or you can contribute 66,000 here, or I can do this and I can contribute the max because it's just me, I don't have employees. There's a lot more that needs to go into your decision with doing that. And a tax professional like myself or your own tax professional, you can sit down with and compare and contrast the better option for you to consider. One of the other things, lastly, and on this topic, that I wanted you to see is the possibilities. Sometimes when we're talking about this, we're just looking at it year to year, and you don't look at it over time of how you can really, really rack up on this with contributing to these plans, right? So let's just say if you invest $1,000 a month in your retirement and you are in the 40% tax bracket, and I would encourage you to supplement that with your tax bracket. And let's say you earn 10% on your investments, right? At the end of 30 years, you'll have 1.58 million in after-tax spendable cash, right? Now, 1.2 million in after-tax cash from retirement plan, that's 2 million gross, less 40% in taxes, right? And we're taking the entire amount out in the plan for this example, right? So let's say you had 380,000 in a side fund, which you created by investing $400 of monthly tax savings, right? $1,000 in deduction times 40%. If you had no government help on taxes and you invested $1,000 a month in an investment that earned 10%, 6% after taxes, you would have a little more than $950,000, right? So when you do the two and you compare it, I think the number ended up being if you did it on your own, right, juxtaposed to putting it into these retirement plans and comparing the two numbers, the difference is 630,000, right? So by using the government, using these plans, using the strategies, you would win by putting it inside a SEP or a solo 401k, roughly, than just trying to invest the money and do it on your own. So I just wanted to put that out there, the possibility that you can see what you can really do with contributing to the SEP and solo 401k plans. Okay, so I know we only had like 45 minutes, so I just wanted to leave you with that. And if there are any questions, or if you wanted me to go into some other tax strategies, I could do that.
I see Gilda has her hand raised. Gilda?
Yeah. Hey, so the 401 and the SEP, do they follow the same rules as you would with a plan that you get from your employer? So in other words, if you needed to use that money that you're putting in these accounts, do you have tax penalties if you need to withdraw some out?
Yes. So the SEP IRA, there are penalties, the same one, the same, 10% if you withdraw it before 59 and a half. You will have those penalties. So it works the same way. And the same thing with the solo 401k. Maybe you decide you want to take a loan out just opposed to a withdrawal. You can do that with the solo 401k as well.
And pay yourself back without penalties?
Yes.
Okay.
Mm-hmm.
Okay.
All right. Well, somebody else has their hand raised. I'm sorry.
Oh no, I'm gonna lower mine. I think that was me.
Okay. Well, Roseline, I want to firstly say thank you. And secondly, if you're willing, if I don't know, if you've been able to work with these yet, but can you talk a little bit about the 162 executive bonus?
Okay, well, I gotta pull something up for that because I don't remember everything about it. What did you want to know specifically?
Well, I mean, I kind of work with them, but the way that you were able to explain them, I think the team would understand them a little better coming from you than coming from me.
Okay, so with the 162 executive bonus, I'm gonna pull something up to see if I can give you an example here. On a presentation that I presented before.
Hey, but before you do that, I just wanted to, with the SEP IRA, SEP IRA, you can do that with, we talking 1099 independent contractors. So even your Uber drivers,
Yeah.
anybody that's a 1099, they can, for your small business owners, they can do that.
Yeah, even the guys who are doing Uber.
Yes, as long as they're organized, yeah, they're organized in a certain way. Yes, you can do certain things with them.
In the solo 401k, that could be for your small business, like your mom and pop, your mom and pop businesses. They can, husband and wife, and you got a couple of kids, like your small businesses. They can set up the solo 401k, and it's really not that expensive, right? They can put up to 22,000 in there. But you said if it hits 250, then they have to start filing the form 5,500, right?
Yeah, and that's where
they can actually have they can have their accountant can be on top of that. So that's something they don't really have to. The accountant will know, okay, that's the trigger point for that filing, correct?
Yeah. Well, look. Even if you're a mom and pop, you can still do a SEP plan. To be honest, a SEP plan can work very well for them too, especially if they don't have employees, because you only have to worry about yourself, and if you're making a lot of money in the and you decided, you wanted to do a SEP plan, it might work because you can do up to $66,000 in contributions if the 25% is not enough because you're a high earner,
Why?
So you're 25. Yeah. So they both work. They both work in those ways. And here's the other thing: if you do a SEP plan, you can do both. You don't have to, and not necessarily the same tax year. No. But if you decided this year you wanted to do a SEP plan, you can do a SEP plan. If you decided another year you wanted to do the other one, you can do that. You don't have to just be stuck with one or the other. You can always change your mind about which one works better for you based on your current situation. Maybe this year you can work within these confines because of some of the other things I mentioned, your cash flow, your age, your income, and then the next year, let's say Alonzo said he's not near 50 yet. So it might make better sense for him to do the SEP. But then let's just say, after he's kicked the door down 50, 51, he's like, you know what? It's a better opportunity for me to do the solo 401k. Now you can absolutely do that. One of the other things I wanted to mention
shout
about
out to all the 40-somethings out here.
I'm sorry?
I said shout out to all the 40-somethings out here.
One of the other things I wanted to talk about with the solo 401k that was interesting is depending on how it's set up, the other opportunity to invest in real estate with those is such a great possibility, because if you can do it, you can do one where you can get control of the book, then you can actually increase the value of your plan by investing in real estate. That's another topic in another time, but I just wanted to put that in other ways of how you could increase the value of your solo 401k. Okay.
You know, that helped me a lot with taxes, because like you said, if you make 100,000, right, and you put 60,000, you put 60,000 of that in a SEP IRA. 60,000 that is excluded from your income, and then it's just the 40,000, right? That's a humongous tax saving, and you're putting that money up for a rainy day, for when you for when you retire. That's so if anybody like yourself, everybody on the call, independent counsel, definitely have one. You know, for yourself, if you have any business clients, self-employed entrepreneurs, at least bring this up to them, right? A way for them to save money, you know, on their taxes.
Right. And it's just good to be clear that, like, if you, whatever you put inside of it, now it's not the amount now that you're going to save in taxing. We're all clear on that. The amount is just through whatever you contribute is going to lower your taxable income, right? And then the amount that you contribute multiplied by your tax bracket is going to give you what you're going to ultimately save on in taxes. So those are two different things, okay? So I just wanted to be clear on that. So really quickly with the executive bonus plan, I learned about this through connecting with Charles and Alonso, and was something that I never done with anyone. And I still haven't. I'm working this into my tax strategies. And the beauty of the executive bonus plan is that it allows you to do two things. You can use it, number one, as a perk, and you definitely can use it to save on taxes, okay? So what you do, I guess everyone here may or may not be familiar, but I assume that most of you are, is that employers can use it basically to retain top talent, and they would get the IUL, right? And I think Charles, right, we can do it with the whole life as well.
You do it with any form of permanent insurance.
Right. So the bonus amount,
you could even use it as for term. It just depends. You can use any policy. Permanent insurance works better because of the cash value element, but you can also use a term policy as well.
Yeah. So whereas before, normally insurance is not a tax deductible item for businesses, this executive bonus is. And what happens is that you kind of, I would suggest doing this if you have the cash flow. That's something else to consider as a business owner, because you're still, you'll still win-win, but the bonuses that you contribute to your employees are tax deductible to the business. And not only is the bonus, the insurance premium, which would be the bonus, tax deductible. Also, you have tax deductibility because you have to pay taxes for that employee on the bonus. So then, it kind of increases it there. It gives you it'll increase the amount of taxes that you'll have to pay for the employee, therefore resulting in a reduction of revenue. Okay. So, and then the beauty of it is that the person who benefits from it is basically free of income tax when it's distributed. Okay. So that's all I have on the executive bonus plan, other than the fact that if it's done really well, the person who is going to reap the benefits of it will have a really good, really good arrangement once it's put into play.
Awesome. Thank you so much. Does anyone have any questions? Any questions? No? Well, I'm gonna show you quickly. I'll show them quickly, because I don't know if you know how to run it illustration, right? And I'm going through the Emeritus portal, right? And this is after you import a case. And this is for a client that I was working with. This is a New York client, right? So you go into the illustration system, and you can do a fixed or indexed annuity. And like Ross said, everyone on the line is licensed to sell fixed and indexed annuities. Now you need to do variable annuities. Now you need your securities licenses, your SIE 6763. But everyone on the call here is life licensed, so you can sell right now a fixed or indexed annuity, right? Because this is a New York product, we only have the fixed annuity. Outside of New York, like New Jersey, Connecticut, anywhere outside of New York, you can do the indexed annuities, right? So what you do when you see the plan type, they give you an option for non-qualified or qualified. You want to check qualified, right? And the reason why, like the SEP IRA, Solo 401k, those are qualified plans. And the reason why they are qualified is because they qualify for the IRC, the internal revenue, the IRS, IRC codes for the ability to all the tax breaks, all the tax benefits, that Roseline mentioned, right? So you want to click qualify. Now under the qualified plan type, you can see all the different plans that we have available, right? I mean, you could do a traditional IRA, you could do a money purchase, you could do HR KEO. We didn't even talk about any of these. These are all another topic, but we did talk about the SEP IRA, right? And we talked about the 401k. You can also do a Roth IRA in here. And you can set up a 457 profit sharing. There's a lot of plans that you have a license to sell, but the difference is the funding of it, right? You can do either a fixed option or an indexed option. So we'll talk about, let's say the SEP IRA, for example, right? And then they have the amount that you want to open up the account with, right? So you might have clients that have funds in their checking account. They may have $10,000 in the checking account, $15,000, right? And the index one. So you just know that you have the index. I believe is 10,000, right?
10,000, yeah.
The index product, you need a minimum of 10,000 to open up that account. And the fixed product is 2,000.
Real
right?
quick, Charles, that's good to know though that with Emeritus it's only 10,000, because with other carriers, like I don't know if some of you write with other IMOs, but other IMOs require a minimum of 25,000.
Well, this the companies, it's not the IMO.
I mean other carriers. I'm sorry.
It's the carriers, the different carriers, like Mass Mutual, for example. I think it's 4,000. Matter of fact, it's up to 10. They just increased it to 10,000. But you have to look, right? So that's another thing else when you're talking to clients. But Emeritus is 10,000, right? And then you can say, for example, how much if the client says, "Hey, I want to set aside $200 a month," right? So you can put the $200 there, and you can change this to monthly, right? So you have a client say, "I'm going to open up the account with 10,000, and I want to contribute $200 a month," which is good because this way they know they have money going in every month and it's coming in, it's being transferred to their account via the automatic investment plan. So it's being transferred to their account every month without them even thinking about it. So you have to open it up, and then you have the monthly plan. And then like now, towards the end of the year, once the account is open, the client has the ability to send a check. You send a check to the plan. They can, if they establish an account online, they can make a payment in there. But right now, because we're going down to the end of the year, right? We call the clients. They can put funds into this up to December 31st, and then again they have another opportunity for April 15th, and then they can actually move those back, right? So this is the main thing. You have it here, $200 a month, 10,000 to open it up, and then you can just click the preview, right? You click the preview. So this is if the client said they want to take a look at it. Now remember, with the fixed product, you're not going to get a lot of interest, but you will get a guaranteed interest rate, which a lot of clients like. So even in this economic environment where the stocks is going up and it's going down, the fixed annuity has a guaranteed interest rate. Also, the index annuity has a guaranteed interest rate. It's guaranteed of 0. So even if the market you have market swings going down, if you have the market swings, you can actually guarantee the funds. Roz, you had a question or something?
Yeah, I was curious. Like, so someone like me, I have employees. So what would I do? I would do a separate one for each one of them.
So now the SEP IRA. Now remember, one of the things about the product specific, you can design it where they have to be with you for at least 3 years, right? Before you can introduce that to them. So they can be 3 years and they have to be a certain. This way, you know, if somebody has been with you for 3 years, you know that's somebody that you can do, right? So yes, you would have to. Each one of them would have to have their own account. Yeah, because those plans, the SEP IRAs are 100% vested.
Okay.
Right? So whatever you put in that employee's account, that employee is 100% vested. So if they after 3 years you put the 10,000 in and they quit, you know that 10,000 is theirs, right? So this is 100% vesting on the SEP IRA. So that's why you can say you want to after 1 year you want them to work 2 years, after 3 years they have to be a citizen. There's certain eligibility rules that you have, but that when you set up the SEP IRA, you'll see, you know, what you can do. But yes, you would do a separate one for each. All right. So you see here, you have it, and this is really what it looks like, right? I wish I had the IUL up here because the IUL looks a lot better. But I just ran this one because this is what I have right here in front of me, right? So the client can see, okay, I put 10,000. To open it up, I put $200 a month in, and you can see what this is. This fund, these funds are growing tax free for them, tax deferred, tax free until they plan to draw that out. All right, so you can run the illustrations. You can run the illustrations for them. I set up a lot of these. When I'm talking to business owner, that's the first thing. Like I opened up the call, I had a tax bill. Like I still owe, right? That's a big problem. Especially that's what tax. Hey, I can help you with that.
That's going to be it for
today.
today.
The money from the checking
Make
account
sure you wipe ass, work in progress every day and
write that off.
Remember, folks, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge.
They let you put into there.
Accept the challenge.
To write that off.
Salute.
So I just wanted to show you how to actually how you get